make sure it goes. Last week I messed that up. All right, and then I also want to share my screen because 3 weeks in a row now on webinars I forgot to do that. So let's see, share screen. Here we go. All right, perfect. So we should be good to go here. I did just hop on for the morning. I have not really looked at any other pairs yet at the moment. These are just ones that I had from before. But I did take a miss on this EURGBP play. It didn't tap me in on my brokerage. I did see some people whose brokerage might have. I also saw one where they were break even on it. So it definitely can vary depending on brokerage. I took a miss here, and then this was actually following a winner that I took. You guys saw this one in the team trade section. Right from this range low to this range high. So I took this one right before on EURGBP, and then obviously another setup presented itself again. Let me mark out my range here. Oops, I'm all over the place. And yeah, I do kind of like these plays a lot when there is a higher time frame point of liquidity taken like this. When there's a significant low that's in place, we know that a lot of liquidity rests below there, especially when prices are retracing. This is your low of the range. A lot of stop losses will rest there. So when that is taken and then we see an impulsive reversal with that fair value gap, I do find these are really quality setups. It is actually something, if you look at our day trading strategy in the day trading section, you'll see that the higher time frame bias is based off something very similar in one of the example trades there where we have a 4-hour range. Price comes right below that range. We see these good liquidity grabs, one here, and then a break of structure is very impulsive. The wicks also show very high volume as well. So that was all around a pretty clear setup to me on EURGBP. I know some people are nervous to go counter trend, but I do find some of the best scenarios to go counter trend is when these points of liquidity are taken. And then obviously we had that second setup right after that one. We hit TP here, and then I had another range that formed. We swept liquidity within the range, the internal liquidity, broke structure again, candle close, plenty of fair value gaps, and this one was just a very close miss. So nothing made there. And then I had, what else did I have? AUD CAD at the moment. USD CAD here is something that I have pending. And then Euro CAD, honestly, I don't quite expect this to make its way back down there, but I'm going to keep setting the order until we see price eventually slow down. This was most likely from NFP, this momentum that we have here, and, you know, I'll just kind of see how this pans out. I didn't have much else. A lot of these ranges, they ran a little bit far for my liking. Sorry, my dog's like pacing around right now. I don't know what she's doing. Yeah, this was something someone sent me. I personally don't take these aggressive ranges, only because I just feel like the liquidity here is very insignificant to the overall trend and price action. Obviously, I don't use higher time frame bias, but you can kind of see after break a structure down and we're working within this range. Why I don't like taking too aggressive ranges like that is because, you know, when the bigger picture is put into play here, something like this is a bit insignificant to the overall movement of price action. Also, it's just kind of tough for me to catch these trades when I hop on one, two. Let me hop in the trading channel and make sure I don't miss any questions. EU loss. Yeah, I didn't see that one as well. It kind of goes in the same boat as this one. It was a bit aggressive for me, but it's because I didn't hop on yesterday. I hopped on the day before to look at some setups. And in the case of this, for example, as well, if I'm not hopping on every day, twice a day, I'm going to miss these tiny little ranges compared to stuff like this where I do have plenty of time, a couple days even before price retraces. Same with this one. This one actually, I had not as much time, but I set it up because after the break of structure occurred here, there was plenty of time to kind of react to it. So EU kind of goes in that boat where I honestly did not have much time, just a few 4-hour candles, and I wasn't on yesterday. So I did miss this one. NFP obviously push price bullish. I don't think it's a bad range. It's just a bit aggressive for my liking. Let me see here. A dog. I'm gonna let my dog outside and I'll be right back. And then we could probably dive into my slideshow that I have. But if you guys have any questions about pairs or anything you want me to look at before we do that, just let me know. Be right back. All right. So my goal today was going to be talking about asset classes a little bit. Obviously, I'm no artist here. Ben's probably going to yell at me for my terrible graphics work, but very basic slideshow. I just kind of want to break down different asset classes and the importance of them, because I do know I've been getting a lot of questions lately about investing, setting up portfolios, what people should diversify into, etc. So first one, you got to start with inflation. Now, inflation is technically not a asset, but it is something that kind of counteracts different asset classes. So inflation typically is 2 to 3%, which is honestly best case scenario nowadays. You're good, Carwin. Not too many people here for a Friday, but yeah, inflation is about 2 to 3% on average. That's the goal at least. The government attempts to keep it around that level, at least here in the U.S. Um, and then a lot of people have their money sitting in a savings account, which you're returning about 0.1 to 1% on that capital. So overall, you're actually losing money with it sitting in the bank. I'm sure many of you have heard this before. To put it into more perspective, even inflation a little bit after the pandemic, I want to say late 2023 was nearing 9. I think it peaked at 9.4% here in the US, which is just astronomical. I mean, that means you're losing about 10% of your purchasing power. It's the reason why we saw things like gas, food, and grocery and whatnot go up so high. You're losing your purchasing power as inflation increases. And this is the reason why, you got grandparents who always talk about how they bought a steak dinner for like a nickel 20 years ago and they try to rub it in your face. But that is essentially what inflation is doing. And over time, the reason why I want to talk about assets is if you guys are going to be making money in the markets, I want you to understand how to actually counteract things like inflation, because a lot of people I know, as you guys know, I was a my Forex funds trader for a long time. I was funded with them and I was very comfortable funded with them. And I had a bunch of friends who were as well, but the issue is a lot of those friends were taking their money, either number one, throwing it in the bank, which understandable if they didn't have the education to go and invest into other asset classes. But number two, they were going and buying and spending on, the materialistic items that everybody wants when they come upon new money, which is fine. But as my Forex funds ended up shutting down, a lot of them lost their livelihoods because of that. A lot of them had money sitting in the bank, losing money due to inflation. And, I guess I was lucky in the sense that I found early interest in things in different asset classes. I've mentioned before a few times, I do have my real estate business that I use, and I have obviously a stock portfolio that I kind of keep up with you guys. I'll show plenty of images and stuff like that in the chat with it. But overall, I just think it's super important to learn to invest, especially when you're coming into an industry like trading where money can start to be made very quickly. It was one of the things I'm most grateful for. I have a lot of buddies who made plenty money on crypto and then ended up trying to go back into the next coin or the next play and lost it all. So I do think smart conservative investing is the route to go. So number two here, I do want to mention the slideshow is in order from least returns to greatest returns. And you'll see why I did that towards the very end, obviously. But number two here is going to be bonds. Now, there's typically 3 different types: government, corporate, and municipal. And essentially, at the end of the day, you are acting as the bank here. You're lending the capital. And your historical average is about 2 to 5% returns. But the key with bonds is very, very low risk. So obviously these returns are not bad at all, 2 to 5% per year, that's per annum. And people do go with bonds typically as they get older. There's certain rules behind it. I'm going to butcher it, but it's like you take 50, subtract your age or whatever, and that's the percent of bonds in your portfolio. That was definitely not what it is, but all I know is trying to think what the rule was there. But in general, my own personal portfolio has 5% bonds at the moment. I'm still fairly young. And I don't see the need to be terribly conservative. As people near retirement age, you're going to find that they buy and purchase more and more bonds. They do have what's called a maturity rate: 30-year maturity, 15-year, 5-year, 1 year. And this is essentially just the duration that you're holding. And how it works on a very basic level is for government funding projects. Let's say the government has a project they're working on. you can actually purchase a bond from them, which in reality you're lending them that money for that project. And the goal is within the maturity date, they expect to be able to get your money back 100% guaranteed. Obviously, nothing's a guarantee, but it is one of the closest investments in asset classes that is a guarantee, especially treasury bonds backed by the US government. I'm sure there's plenty of similar things for those of you that are international. And then there's corporate bonds and municipal, which corporate bonds, same kind of idea. If Simple Markets came to you guys and said, hey, we're trying to build an investment fund for you guys to trade for us. Can we get $500 each? And then we'll pay you back interest, and you would end up over the certain period of time making, let's just say, $700 on your $500 investment. And it does help Simple Markets make a project that's kind of similar to what it would be in the corporate world. Obviously, we're not going to take money from you guys and go build some investment firm, but the general idea stands where if a company is trying to fund a project, they might offer bonds and have people exchange their money. Essentially, you are lending your money to them, and then they'll pay interest on that, so you gain more on your investment. And they're one of the more safer investment and asset classes that there is. And municipal is the same thing, it's just on the state and town level. And then after this, we're going to talk about commodities here. So gold and silver being the two commodities we're going to talk about. They're looked at as a safe haven to many people. They are very volatile. However, gold looks to return about 1 to 3% per year, and silver is about 2 to 4% a year. Commodities personally are not something I do have a collection of watches, gold, silver, but I don't personally buy gold coins or silver coins. That's just my preference, I guess. But like I mentioned, it is a bit more of a safe haven currency. It's a lot more risk averse. And you'll notice as we are at the lower end of this slideshow here, where we're on the first few steps, it's going to be typically low risk things with not the greatest return on investment. It's going from least to greatest. And it's mostly just because the more risk you take on, the more returns you can expect. Let me check here. I got a message. I just want to make sure. And so yeah, gold and silver, not something that I dabble too much in other than like my watch collection, which yes, technically watches are an asset. They're not going to be listed here because a lot of people don't use them as an asset. They buy the watch, they go and wear it, beat it to shit, and then try to resell it years later for more. It does not work in that case. Now we're going to dive a little bit into stocks and ETFs. Oop, didn't think that would... All right, I guess should be able to... All right, we'll watch it on Reddit, I guess. I don't even have a Reddit account. But basically what this is showing is that stocks annualized a real return is a return that's adjusted for inflation. So we talked about inflation being about -2 to 3% per year. So this is taking that into account. And you can see as the years go on, the red represent people that return negatively on their stock portfolio. Typically, this is based on the S&P 500, or it should say here, reinvested dividends as well. That's something to keep in mind as well. If you're reinvesting your dividends, this is what the data would be. But the general idea that it's trying to show here is that over a certain period of time, the more years that go on, there is actually a point where I believe it's the 23-year mark. Stocks have never returned a negative value. Let's see here, 21st year mark. Stocks have never returned a negative value over that period of time. I just think it's important to know. And obviously, this is talking mostly about indices and ETFs. If you go and buy some terrible company, terrible stock, and hold it for 20 years, you're not going to be happy with this type of return. But the general idea, and the reason I bring that up, is there's a bit of a bad connotation behind the stock market. People are almost afraid a little bit to go and put their capital into something like the S&P 500. I also brought out this calculator here because I do want to show kind of the importance of it, but 8 to 10% average, we'll just go 9 years and we'll set it to 10 years. And something that I like to mention, this was even to students in the way pass that I've had in trading specifically, is with things like prop firms. I have students who made $500 for their first payout, $600 for their first payout, and people were almost discouraged by that because it wasn't, I guess, enough or what they expected off their first payout, which money in the markets is money in the markets in general. Like, never be discouraged by making $500, $600 online from home in a few minutes a day. But I was trying to explain to them, if you had a portfolio and started with, let's just say 2,500, and you managed to, make $500 from the markets and go and put that into a portfolio, um, month after month, into something like the S&P 500, where you're looking at an average of 9%, you could reach a value of six figures in just about 10 years, which is massive for the majority of people, especially, in the United States. You might be struggling a little bit here, but in other countries where you can have an excess of $500 per month, let's say you make it on your Forex portfolio, let's say you make it from prop firms and funding, that little $500 contribution each month as a payout is astronomical when it comes to long term, if you're being smart with it and what you do with it. When you can see down here, your total contributions over those 10 years is about 60,000. You're almost doubling your capital here, a little bit less, over the same period of time, simply by putting it away into a smart asset class, as opposed to going and spending the majority of it, wasting a lot of it. So I do try to really bury those good habits into people. And I also think that's one of the most important reasons when I mention you guys should start your portfolios sooner than later. Because once that portfolio is started, you have, let's say, the 2,500 in there. It's very, very easy to then go and add money to it. The hardest part is starting the actual portfolio, and the more time that goes on. For example, 20 years with the same thing. Now you've doubled the time period, but you've almost 350% increased the capital. And obviously time is your biggest factor here, comparative to 5 years where you're less than half of 100 grand now. So time is your biggest factor, and that's why I really, really try to enforce people starting their portfolios sooner than later. And even, like I said, if it's something as simple as putting money away in the S&P 500, and that's the beginning of your portfolio, it's a really good base, and it's something that you can build off on longer term. Let me double check that the recording's going to. Need some water. My voice is giving out. And obviously, if you guys have questions about starting a portfolio, we have the investing section, where I do talk about just opening a brokerage account and buying the S&P 500. But obviously, if you want to DM and whatnot, I can help out and help you set up your portfolio and everything. Just 1 second, I'm going to let my dog back in now. All right, what time is it? 10:24. Still got some good time here. Are you guys able to guess what the next asset class that I might mention on here is going to be? If you guys want to type it in chat and take a guess. So to recap, we've gone through inflation, which is a negative return, and we're working our way higher up here. I guess this was mostly on savings accounts, but the idea that inflation is negatively correlated to that. So you overall net negative when your capital's in the bank. We talked about bonds, which are much more conservative. Then commodities, which are a little bit more volatile, but still a fairly conservative investment. Stocks and ETFs. So if you guys want to take a guess, Joseph says real estate. I see you type in too, Justin. I'll keep an eye on chat for you guys, but I will give it to Joseph here. Yes, real estate is going to be the next option on here. Now, if you do notice, it is roughly 8 to 10% historical average as well. It does depend on your niche. There's plenty of different strategies. I can kind of dive into that a little more, obviously, because I'm gaining experience in real estate over the last about 2 years now. But I am definitely a little fish compared to some of the people I work with and network with, just even in my market in general. But despite it being a similar return to something like the S&P 500, I guess there's two things that come into play here. One of them is preference. A lot of people feel more comfortable in the investing niche, which I would assume most of us, because we're already involved in the markets and kind of have a good understanding of it, compared to some people who are more, and when I say investing, I mean in the markets. And then there's obviously some people who they may grow up around real estate, they may have gotten their real estate license and then wanted to shift into the investing niche. And those people just might be more comfortable around property and understand the back end of it. So that might be something that they like. I really do recommend for those of you that are making money trading longer term, going and pivoting into something like property. I think leveraging the two together is fantastic. But despite this being an 8 to 10% historical average, again, personally in the US, the tax benefits of real estate far outweigh the tax benefits that I receive in the stock market with my investments. There's plenty of tax benefits here in the US that I can take advantage, and that 8 to 10% is realistically looking somewhere between 12 to 15 when it comes to savings at the end of the year. And this is kind of regarding buying and holding real estate, which would be you buy a property, you hold that property, and it obviously appreciates in value over time. But there is the investing niche, and this is where things can kind of obviously ramp up a bit aggressively. And it's more of a business than it is an investment or an asset class. But the Burr method, which is, I always forget this, but buy, rent, renovate, refinance, and then repeat. Um, and basically, what that means is you buy a property, you rent that property out, you work to repair that property, and it increases the value. And then once you increase the value of that property, you can actually readjust the terms of your mortgage and your loan, and you can pull the equity out of that property and have cash. And most cases, the repeat factor here is you take that cash from your refinance, you go and put a down payment on another property, and you do it again. I do very lean monthly world and some in crypto, higher risk, some money in bank account for backup. I'm gonna buy an apartment. Yeah. One thing I do recommend, I'm not sure what you mean by an apartment that pays itself off. Maybe if you're talking about like a house hacking scenario, is what I would assume. That's something that I can really recommend for those of you that are trying to get into property or looking to buy your first property soon. And essentially what that means is buying a multi-unit. I apologize if it's different in other countries. I really don't know real estate law outside of the US. I'm sure it's very similar though. But when you go to buy a property, you can buy a, for example, triplex or a quadplex. Is the quadplex is the limit here uh, in the US using what's called an FHA loan, which is a first-time homeowners association loan. That's about 3.5% down payment. So you don't need a crazy amount of capital to get started. You can buy a triplex, for example, or even a duplex, and the goal is you rent out those other units, and you should be able to cover the price of the mortgage utilizing those other units. That is a great way, in my opinion, to start in property because number one, you're going to have a place to live. You moved out, but you'll have other units. You can kind of learn the ins and outs of the back end, which I think is super important. Just getting a basic understanding of things like the different expenses that are going to occur when you are a landlord, even things like property management. You might want to go and hire property management down the line. Another example here in the US is what's called PMI, which is your mortgage insurance, which is necessary if you have less than 20% equity in a property. There's a lot that goes into real estate, but I think practice makes perfect at the end of the day. And I do think it's a fantastic place for a lot of traders or people just making income in general outside of their job to go and pivot towards. I see a few people type into. Yeah, I mean, of course, I've had struggles and setbacks. That's a given. Um, I don't dive too much into like the personal things that I've gone through, obviously, and like because our server's growing, and I'm not too open about stuff like that. How do you manage your taxes when the government takes most of the profit away? There is huge tax advantages. Personally, mostly in the real estate sector. I will say though, if you're investing your capital into the markets and you're leaving it there to compound long term, I think that's one of your best ways. I'm answering Joshy's question and then I can get back to you, Justin. But The government, honestly, here in the US, it's mostly learning to utilize the advantages. Now, I have a CPA who does my taxes. I would be dead without him. I have a general idea because he is great and he walks me through what he's doing. It's actually a father-son duo, but they walk me through what they're doing specifically and kind of give me a little knowledge on it because they do understand I'm younger, and I feel like they enjoy kind of teaching me. But I would be lost without them. I do think the first thing you should be doing is hiring a tax professional. But for example, in things like property, you have depreciation, which can deduct your taxable income. For simple markets, as an example, this is a business, and any expenses that we incur in the business deducts on your taxable income. So you're actually taking less taxes upon based on the revenue that you make. So there is plenty of different write-offs and advantages to taxes, especially with property. Um, Something called, for example, a 1049 exchange in real estate is if you sell a property and within 3 months you find another property that you're going to buy, you can actually roll over that capital completely free of capital gains tax, which is massive as well. My long-term portfolio, I can dive a little more into this in the future if we need, but my long-term portfolio, for example, I put a lot of capital away in there, and what I can do is actually take a loan against that asset. So I can go to a bank and let's say I want to put a down payment on a property. I can say, hey, I would like to use, put a down payment of 80,000 on this property. Can I use my portfolio as collateral here? They're going to need proof of income as well. That's a whole other story. It comes from, you can use 75% of the income from the property. That's a whole other thing. But the general idea is if you're keeping your assets intact, you're not selling them off, because the difference would be if I wanted an $80,000 down payment, instead of taking a loan against my asset that grows at 8 to 12% a year, I would have to actually sell off roughly, I'm going to call it 100,000 to make the numbers easy, but you're going to get hit with that capital gains tax once you sell it out of your portfolio. So you want to try to keep, in my opinion, or my advice, is just keep putting capital into your stock portfolio and letting it sit for the long term. Don't be the person that keeps trying to sell it, buy it, sell some more, buy a little over here. Just long term, consistent growth, and use that as leverage or collateral when taking loans against it in the future. And that's one way to avoid that heavy capital gains tax, which is, at least in the US, 30% for anything under a year, or 15% if you hold it for over a year. Let's see. Take a credit from the bank, buy an apartment, rent it, pay off the credit. Yeah. So very similar. We call that a mortgage here, I'm assuming is what you're talking about. But yeah, you take a mortgage from the bank to buy the apartment, rent that apartment out, pay it off. So that's very similar to the house hacking I was talking about. The only difference is when you say like an apartment, I'm sure you mean like a multi-unit. But yeah, that is a great strategy in my opinion. Been learning about the FHA strategy. We're in Canada, it's called the CMHC. Yeah, so I have no idea what CMHC stands for, but in general, it's just a way to get started, especially for some of you younger guys who might not have a ton of capital to go and buy a property. It gives you a chance to put less down up front, which I think is a huge advantage, especially because when you buy property, and here in the US, the typical down payment is 20%. I can put up, just to make the numbers nice and easy, 20,000 to own an asset worth 100,000. And I think that's extremely valuable because, as we see here, let's just say the property appreciates 10% in a year. That property is now worth 120,000 after 1 year. Or sorry, 110,000 after 1 year, but I only put 20,000 into it. So I made a $10,000 increase on my initial $20,000 deposit or down payment. Hold on. I see Carwin's thing going off, but I don't hear him. Let me see. All right. I don't think my mic was on. All right. It looks like just static too. I just wanted to make sure you weren't asking a question or anything. And then, do you buy stocks for dividends with positive capital appreciation, or generally S&P beats it? Sounds similar to S&T, Rich Fordad. Good, yeah, good debt. So I personally my recommendation would be start with something like the S&P and use that as a base for your portfolio. And I always recommend what I would call play money in a portfolio. Keep it fairly low. The younger you are, obviously, the higher it can be if you want to keep it at 10%, 15%, quote unquote, play money, meaning, investments in stocks that you expect to have crazy returns. Maybe you did some research on a private company and you see huge potential in them, things of that nature. I think you want to keep very minimal in your portfolio. I think overall, keeping a strong base of like the S&P 500, maybe that can be 30% of your portfolio, and then the other 70% can be allocated towards a little bit more risky strategy. I personally have a lot of my portfolio in the S&P, and as well as I have international stocks that I hold too, just to kind of hedge against the US economy. But overall, I think it's generally, if you're going to be keeping a lot of capital, like I mentioned, long term in your portfolio, it's probably best to keep it on the safer side. So something that you can trust in the long term, like we looked at in this previous image, for example, over the course of about 20 years, the possibility of returning negative on US indices is very, very low, if not zero, in the longer term. What international ETF do you have? I forget the ticker because I'm with Fidelity, and it's like 5. FXAIX is my S&P 500 ticker, and that's the only one I know off the top of my head. I want to say it's like FXU. Oh man, I'm gonna butcher it. But regardless, Fidelity has their own ticker symbol for international index funds. The ones that you guys are talking about, VTI, VXUS, that's actually the Vanguard equivalent index fund. Both of them are great. Both of them have really, really low fees, almost indistinguishable amongst each other. So obviously those are good options as well. The only real difference between like an ETF and an index fund is the index fund is based on your brokerage. So for example, mine is Fidelity. That's why it's FXAIX and not just the S&P 500. So same thing with Vanguard. I believe VUSA is the one for a lot of you guys here are international. I believe that is your international index for the S&P 500 with Vanguard. There's VOO, that is for the States, your S&P 500 index. So there is different varying names, and I get that that can be a little confusing for some people. The only real difference there is you're going to be looking at smaller fees and stuff if you go with your brokerage, or just go with a solid index. So FXAIX, the Fidelity one that I use for the S&P, is actually the lowest fees overall out of any index fund. So that is, in my opinion, why I prefer to use them. I think Vanguard is a great option as well. And if you really break down the math, I think Vanguard is like 0.002% more in fees, something so indistinguishable that it doesn't necessarily matter. All right, let me get back and I'm just making sure I don't miss questions elsewhere in the server. Let me take a drink of water too. All right. So we talked about real estate. Now, can you guys? I'm curious. I don't know if you guys will get to the next one. Feel free to put it in chat if you want. But once again, keep in mind we're holding on to that trend of trying to increase the asset classes. But of course, risk is going to increase as we go. And then obviously I'm going to tie this together at the end, so don't worry. I'll tie it back to you guys, of course. I guess that's a little hint for the future. But the next one here is going to be business or venture capital. So you think someone who has a profitable... Hold on. Do you think when someone has a profitable, tested edge, and decent psychology, they can still be unprofitable and just need time? I'm not quite I'm a little confused by the question. I don't know if you're saying, do you think they could still be profitable? I think it goes either way, though. If you have a profitable tested edge and your psychology is learning, you're on that learning curve, you're 100% going to see profit over time. The only thing I will say is there is this this gray area, and that is the area where you have a profitable tested edge in back testing in simulated market, but then you bring it to a live market and you're taking your what's called falling off plan. And that would be when you get to a live market, you're so eager and confident because of your back testing, you might be taking more trades, less quality setups, kind of just pivoting slightly away from that mechanical style. Your liquidity sweeps might not be as aggressive, or might be too aggressive on a live chart because you're so confident in your back testing that it's going to hurt your data long term. Missing winners is a very common one as well. You might have profitable back tested data, but you get on a live chart in the fear of taking more losses, or in drawdown, you might sit out of trades that are winners. There is a lot more variables in play. It's not just profitable tested edge and jump right to a live market and you should be fine. But obviously, if you have a profitable tested edge, you are you're the majority of the way there. All it comes down to is, can you replicate that in a live market? Number one, psychologically free. And number two, making sure you are as close to trading as your back tested data as possible. And I find that's where the issue can lie as well. Some people tend to let the emotions seep in very slightly without them even noticing, and they end up trading a little more aggressive, a little more conservative, a little more with fear in the back of their mind of losses. And so there is some minor variables there that can affect it, of course, but over time, your psychology is going to increase, your practice is going to be there, and you'll start seeing that consistency more and more. So business and venture capital, highest risk, keep that in mind, but high reward. It's very similar. Obviously, it's kind of different than penny stocks, but it's similar in the sense that you're looking for small companies, private traded companies that you see potential in the future, and you feel if you give them investment capital, you're going to help this company get to a place they need to be, and you're going to get returns on your capital as well. No, I don't mind the interruption at all. You guys can ask me whatever you want. I mean, it's an open book, open session here. I just have, something to keep us all busy too. I'd rather go over a slideshow than I would sit here and just answer questions if chat's slow. But sorry, my voice is killing me by the time these sessions get close to ending. But venture capital is your highest risk to high reward, 10 to 15% average. There's an asterisk here because there is obviously cases where people have 100x, if not more, on their capital from a private equity. And what that essentially means is if a business is very small, you might be able to go in and say buy 20% of that business for, as an example, let's just say 100,000, and then the price of that business over time, as they use your $100,000 investment, they now can leverage more marketing channels. They can maybe increase their product quality, whatever it may be, but it allows them long term to grow that business, and you own 20% equity, meaning that your capital is also growing as the business does. This is very similar. I'm sure some of you guys are familiar with Shark Tank. The same idea here. They're venture capitalists. A lot of those people that go on Shark Tank, they have a product or a business idea, and if the sharks see that there's value in it, they'll pay X amount for X% of the company. There's a little bit more that goes in. There's a lot more that goes into it. There's like company evaluations, for example, before investment calculations and after. There's a little bit more that goes into it, but the general idea is you're looking for those companies that are budding and have potential in the future, and you're investing your capital in them for them to grow, and the exchange is you get equity in that business. However, the reason it's very risky is because these small businesses can fail, and it's much easier for a small business to fail and go under. And if that business does go under, your investment is now gone to zero. You've lost your capital. So it is very high risk in that sense. But obviously the highest risk to the highest reward. Now, there's one more and the very final one on this whole slideshow. And this one I want to have you guys actually answer and take a guess on what you think it might be. Mark Cuban made crazy profits buying the Mavericks. Yeah. So that's a little bit of a different example. It's not necessarily a venture capitalist investment, but yeah, he did make plenty money off buying the Mavericks. He's a smart businessman. I watch a lot of documentaries on him as well. And he's even getting into the healthcare niche now, which I think is a extremely huge market, especially here in the US. But the very last one here on the slideshow, I'm sure you guys will be happy to see this one. Crypto is your guess. That's a good guess. You know what? I'll talk a little bit about crypto because I feel like I could have added it after this. Yes, there is the chance for very high returns with it. Yes, it is extremely risky, in my opinion, probably even riskier than venture capital. Um, but there's definitely some returns to be made there. Someone asked me about Bitcoin the other day in chat. I got in Bitcoin at about 20K, and then I took the majority of my equity out at the all-time high. And I do have some equity left, just kind of letting it sit and see what happens in there. But I'm personally not the biggest fan of having a lot of my portfolio in crypto. I have about, I'd say 3%, 3 to 4% of my net worth is in crypto. So maybe I can scale in the future if I would like, but it's just not something that I personally hold plenty of. But I do think there is returns to be made there. Let me grab a drink. Derivatives. Now, so here, the answer is hopefully you guys down the line is the answer and kind of where I'm at the moment. But personal trading, this is something and kind of the mindset that I want you guys to shift towards when it comes to your trading is understanding long term what it truly means. We just went through an entire slideshow of asset classes. We talked about real estate, we talked about stocks, we talked about bonds. All of these things are fantastic returns, but I want you to understand if you gain the consistent skill of returning even something like 36% per year, you can see comparative to any of these other things we've talked about. You know, this is just a 3% return a month, which I think is very, very doable. Plenty of you guys may have already made that. I personally have returned, 36% a year. I hope I didn't say month, but 36% a year, 3% a month is, I believe what I said is what I meant to say, which I think is very doable. That's something that I've done for a few years now in a row fairly easily. I don't want to say easily. Obviously, there was a lot of a learning curve that came into that. But 36% a year is a target that I don't think is ridiculous. But I think when you compare it to other asset classes, you can start to see the real advantage of having a personal trading account or just in general that skill of trading, because as we talked about, all of these asset classes are something that you and I should be taking advantage of and investing in. But the other end of the spectrum you should look at is if you are someone who has a lot of capital and you're a very wealthy investor, instead of going to something like venture capital where there's a lot higher of a risk, you may take that capital and go to someone like one of us and have them trade their money for you, and we can get a return for that. So that's what we call private investment. It's something we talk about a lot here as kind of an end goal. It's similar but different to prop firm funding. Obviously, prop firm funding nowadays is a little bit more focused on simulated markets. There is some real prop firms out there. Well, the original model of prop firms was you trade with real capital and the company scales it for you. They are still out and about. They're a little bit of a different format than this whole simulated funding style with, I hate to say fake accounts, but we'll call it simulated accounts. I don't know what an IB is, Joseph. What do IBs do? I'm not sure. But the general idea here that I'm trying to get across is once that skill of trading is developed and you have returns like this, you got to understand from the eyes of a very wealthy investor, a private investor, looking at, okay, I can go and take some risk on into venture capital, or I can take a lot of money and give it to someone who has that skill of trading and consistent returns. And I have seen, investment bankers, very similar, honestly. They kind of just do this in the professional setting. Here in the US, you need to get your Series 7, which is just your baseline qualification. There is a lot more qualifications to go through. So it is different than private investment, like I'm talking about. So private investment, the majority of the time, it's going to be contract based. You'll have a contract in place with the investor. They will give you a certain amount of capital. The terms can be very loose because it is an A to B scenario. Sometimes lawyers involved and whatnot, depending on where you are and the law. But the general idea is if an investor wants to come to you, or for example, let's just say I was going to private invest one of you guys. You showed me your data long term in a live market. It was making, let's just say, 36% on average. That might be appealing to me because, well, that might be appealing to me because I know I can't get that return on real estate. Or if I put my money into my stock portfolio, I know that if I go to so and so in simple markets, he can make me 4 times as much in a year that a real estate property I could buy would make. That's why it's so appealing to private investors. That's also why being a trader is extremely appealing in the long term. Is through my journey, I've met so many guys trading multi-millions for private investors. One of them, his name was Danny. I don't even want to know how large his account is now, but he was trading an $8 million account. Um, Kind of the terms in his contract was just about 2 to 3% gain per month on an $8 million account. I believe his profit split was 55-45, meaning the investor got 55%, 45% went to him after each month. And essentially all it was is he happened to know a very wealthy family who started a construction company. And that family pulled together about 8 million in capital, and they wrote a contract with Danny for him to trade for them. And any returns that he made on the account, he kept 45% of the profit, 55% went to the family, and they continued to actually scale higher and higher with the amount of investments that they gave him. More he returned on it. And I do put that out there as an idea of really the sky is the limit when it comes to having this skill as a trader and what you can do down the line. I don't want to say it's easy to find private investing, but it's something that if you're looking at and you have a proven track record, you can go out there and start talking to people who are very wealthy. It could be someone in person even. It doesn't have to be these, very specific people. If someone had a disposable, let's say 50,000, they were a very wealthy person off of a business or whatever, you could trade that 50,000 for them, and it's similar to how funding works with FTMO and whatnot, but obviously much, much more scalable. FTMO caps you out at 400K, I think. MFF capped you out at 600. So I think the sky is the limit represents the idea of finding people who are much, much wealthier, and there are people out there, trust me, looking for greater returns on their capital. It really goes to show how far trading can be pushed. It's one of the only asset classes where you're going to get returns like this or even greater in a year with much less and much more minimal risk comparative to something like venture capital. Let me grab another drink here. Is there any questions about all of this either? Because I might be ready to wrap it up pretty soon. That is the end of the slideshow here. My voice is dying. Whew. All right. If there is no questions, then I might be ready to wrap it up. Let me just make sure here. Check some other channels too. I got some notifications here and there. All right. I should be ready to wrap it up then, guys. Thank you all again for coming here. It's a pretty slow webinar, not too many people, but this will be posted and recorded. I fixed my OBS, so hopefully no issues like last week. It should be up probably within the next few minutes. But that is going to be all. And have a good weekend, guys. Stay safe, and I'll see you next week.